CEOs of member banks, and the KBA CEO, Dr. Habil Laka, distinguished guests here present today, researchers, discussants, and reviewers who are here today. We are quite honored to have you here today. And as we start off, we always say, feel at home. This is our premier event that helps us discuss matters banking, research on banking, because we always endear the spirit of anchoring our decision-making on evidence. So we are privileged to have you here today. And also just for noting is that we have over 200 participants online following virtually. So we will endeavor to keep all of us up to date and clarity of information reaching all of us. And again, just for noting is that we also have participation from outside the country. We are widening our scope to reach out to the East African region and soon beyond. And we are privileged today to have participants from Rwanda, participants from Uganda, from Tanzania, and even some of the authors are dialing in from Australia who would be making presentations in the course of the 3 days that we have this workshop. So without much ado, allow me to just shed some light on the theme for this year's conference. The theme for this year's conference is looking at 3 things, and it's titled Banking Industry Dynamics on the Back of Technological and Financial Innovations and Sustainability, Emerging Risks and Opportunities. So here we have a chance to look at the compounded effect of COVID, now that we are almost 3 years down the line with the pandemic here with us, and of course affecting banking in its own unique ways in terms of risk characteristics, and of course the mitigations and the adjustments that banks have had to make to just stay away from the adverse effects of the pandemic. Then secondly, the implication of the emerging digital financial services. We are in a digital age, and as we get into this space, it's important for us to look into the risks that emerge with technology that has been embraced so dearly in the banking sector. And of course, in this research, we have papers lined up to really look into the digital financial innovations. Then third, we interrogate the status and trends in the uptake of green finance. This is an emerging issue. Sustainability is becoming core, not only in the regional space, but also globally. And therefore, we have a chance to really look at where are we in terms of aligning our books as a banking sector with sustainable finance. In this space, we also want to acknowledge that the partnerships that we are developing now are very, very, very strategic. Even today, we are privileged to have the Director of IUCN Kenya, Mr. Charles Karangwa, who is here with us also to demonstrate that as we partner on sustainable finance, there are also nature-based solutions. We'll be hearing some bit from him much later. So without much ado, allow me then to invite CEO Kenya Bankers Association, Dr. Habil Laka, to substantively welcome us all. Thank you.
Yeah, thank you, Samuel. Let me start by recognizing the presence of our chief guest and keynote speaker, the Principal Secretary, National Treasury and Planning, Dr. Julius Muia. Let me also recognize the presence of the Kenya country representative and regional head for IUCN, that's International Union for Conservation of Nature, Mr. Charles Karangwa, as Dr. Tiriongo has indicated. Let me also recognize the presence of the chairman of Kenya Bankers Association Governing Council, who is today represented by Mr. Kihara Maina, who is a member of the Governing Council and the CEO of I&M Bank. Let me also recognize members of the KBA Governing Council who are hereby present, the bank chief executive officers who are hereby present, distinguished guests, ladies and gentlemen, good morning. It's my singular honor to welcome you all to this 11th KBA Annual Banking Research Conference, and I sincerely thank you for joining us today. Today marks the 11th year that you're carrying out this activity, and over the last 10 years, we have consistently hosted this Kenya Bankers Association Banking Research Conference, driven by our commitment to deeply engage with our stakeholders and anchor the banking sector's development on evidence from research and analytics in areas we consider critical in enhancing the industry's contribution to economic growth and development. And therefore, as we hold our 11th annual research conference, I take this opportunity to specifically acknowledge our dedicated researchers, the reviewers, and discussants for your invaluable input in keeping the engagements alive and research driven by evidence as you generate insightful contributions to the various thematic areas. At KBA, we strongly believe that it's out of a candid engagement with the stakeholders, underpinned by rigorous analysis, that we can mine robust ideas supportive of the financial sector's growth and development aspirations. We take note of the fact that some of the issues that we discussed, that we addressed in our previous sessions, have either given rise to practical solutions or have motivated further investigations by other researchers. The themes we have picked have undoubtedly resonated with the desire of the industry to be at the frontier of knowledge and practice. I must also highlight the fact that over the past two conferences, we have opened up contributions of papers to include pieces that are methodological in nature, providing insights towards practical solutions to challenges affecting the banking operations. In addition, and as you will notice in this conference, we have one framework paper drafted by a legal practitioner in the banking industry, detailing the legal and regulatory framework for the digital financial services in the country. We have also broken boundaries to host research papers from authors in countries in the EAC region. Indeed, we continue to widen the scope and catchment area for the insights we so need in the banking sector in the region, taking advantage of the EAC region. Our theme this year, as Dr. Titongo indicated, is banking industry dynamics on the back of technology and financial innovations and sustainability, emerging risks and opportunities. Under this theme, we seek to appreciate how the current operating environment for banks is characterized by evolving risks and its management strategies, the emergence and adoption of innovations, and the global focus on green and sustainable finance options. These developments are increasingly becoming core in banking on a global scale, and hence the need to deepen our understanding. This conference brings together a diversity of our stakeholders and researchers. In this regard, we acknowledge that in the course of deliberations, we are unlikely to have common views on the issues to be discussed. In fact, consensus is not a necessity. In recognizing this, it's always our call to ensure that objectivity is maintained even in instances of divergent views. And I wish us all well at the conference. I hope that the outcome of our research papers that shall be showcased will contribute, not just in the debate amongst researchers, but will also be a basis for policy formulation at both institutional and national levels. And at this juncture, ladies and gentlemen, allow me to invite the chairman of the KBA Governing Council to make his remarks and introduce our guests. Thank you very much.
Thank you, Dr. Olaka. And let me also begin by recognizing the presence of our chief guest today, the Principal Secretary for National Treasury and Planning, Dr. Julius Moya, who is a regular and ardent supporter of the KBA. We were here not too long ago at the SME conference, and we are pleased to have you here again with us today. Let me also recognize the presence of Mr. Charles Karangwa, the IUCN representative. We were advised that the governor and the deputy governor who were to join us today have sent their apologies, but we recognize the very strong support that they offer, and I know they would have wished to be with us here today. Let me also recognize members of the KBA Governing Council that are here present today, and bank chief executive officers as well, and recognize our hosts, really, the KBA CEO, Dr. Habil Olaka, and Dr. Samuel Chiriongo, who's the head of research for the KBA. Other distinguished guests, ladies and gentlemen, good morning. I am speaking on behalf of our chairman, Mr. John Gashora, who couldn't join us today. And the remarks I'll be making were actually his remarks, so I'll read through them with fidelity. So we're really pleased that you could join us today at the 11th KBA Annual Banking Research Conference. And I will add that we're really proud that this tradition has continued. It is really the envy of other associations, banking associations around the continent, that we are able to really have a strong research basis for some of the policy decisions that we make. The banking industry is often described as the central nerve of the economy, and this is for well-justified reasons. General economic prosperity and the development of the banking industry are closely intertwined. When banking intermediation works well, this is directly reflected in the prosperity of an economy. And this is also true the other way around. In this regard, deepening our understanding of the operating environment and the challenges present through research has increasingly become a necessity. This is particularly the case considering the dynamics of the Kenyan market, observed both at the policy front and the broader economic environment under which banks, just like other businesses, operate. It is in recognition of these dynamics that at Kenya Bankers Association, we continue to ground our understanding of the current and emerging issues affecting the banking sector on evidence that is generated through robust research. We are very deliberate to involve our key stakeholders in the research we conduct to ensure that the outputs generated speak to a diversity of views, thereby ensuring that the contribution of the banking sector to the economy is well anchored. The choice of this 2022 conference theme, titled Banking Industry Dynamics on the Back of Technological and Financial Innovations and Sustainability, the Emerging Risks and Opportunities, is therefore not only timely, but also puts a spotlight on the evolving environment under which banks are operating and the emerging global trends. Ladies and gentlemen, under this year's research theme, we focus on the evolving risk in the banking sector and highlight its management strategies, the emergence and adoption of innovations, and the global focus on green and sustainable financing options. These features play a central role in the future of banking in Kenya. It is evident that while Kenya is a good example of the positive interplay between financial developments and overall economic progress, supported by a remarkable record on the financial inclusion front, we still have some ground to cover in entrenching a stronger bond between finance and economic prosperity, as well as developing linkages with global development aspirations. As an industry, we continue to map out strategies to promote banking sector development and stability by embracing dynamism and innovations and enhancing efficiency to the benefit of the banking public. We do so through collaboration with key stakeholders, namely the Central Bank of Kenya and the National Treasury. It is through such collaboration that we have collectively managed to make headway in several areas, including the progressive use of credit information sharing mechanisms, promoting transparency in pricing through the rollout of risk-based pricing frameworks, working towards modernizing the national payment system under the National Payments Act, mainstreaming digital banking platforms, and journeying together in embracing climate risk in the banking sector. This progress has been underpinned by a collaborative approach, supported by a strong policy and regulatory regime that has assured stability. We seek to continuously explore ways of, firstly, consolidating the progress that we have made so far, secondly, identifying the inadequacies, gaps, and inefficiencies, and thirdly, remaining on the knowledge frontier on matters of financial policy evolution and emerging market dynamics. It is through such forums as the Banking Research Conference that we seek to engage our minds on such issues. To this end, therefore, let me appreciate KBA's Center for Research on Financial Markets and Policy for playing a key role in setting the research agenda for the sector and pulling us all together with our stakeholders to deliberate on key issues that are affecting the financial sector. I would also like to thank the KBA member banks for their ongoing support of KBA's research efforts. As I congratulate the authors for being selected to present at this important forum, let me also say I look forward to reading your final published works. I wish to thank the Central Bank and the National Treasury for their continuous steady leadership of the industry and for always keeping your doors open for consultation on matters that affect the industry. Ladies and gentlemen, it is now my singular pleasure to welcome our chief guest, the Principal Secretary of the National Treasury and Planning. Okay. Right, so we'll change that around a bit. So we will ask Mr. Charles Karangwa to make some remarks, and then we will invite Dr. Julius Moya to address us. Thank you very much. Mr. Karangwa.
Thank you very much, Mr. Kihara. Allow me to recognize the presence of the chief guest, Dr. Julius Moya, Principal Secretary, National Treasury and Planning. Again, Mr. Kihara Maina, CEO of I&M Bank, but also member of KBA Governing Council. Dr. Habil Olaka, the CEO of Kenya Bankers Association. Dr. Samuel Tiliongo, Director of KBA Center for Research and Financial Markets and Policy, who is also behind this conference. Members of Governing Council, conference participants joining virtually and physically, ladies and gentlemen, good morning. On behalf of the International Union for Conservation of Nature, IUCN, particularly the Regional Office of East and Southern Africa Region, and the Kenya Country Office, we are very much pleased to be part of the Kenya Bank Association's 11th Annual Banking Research Conference taking place here today with the theme as mentioned. IUCN, the International Union for Conservation of Nature, recognizes the key role research and science play in informing policy development and action. And we are pleased to partner with the KBA and mostly in organizing this conference that seeks to provide platform to reflect on the environmental, socio-economic challenges that the banking sector is facing, but also focusing on governance and other things that could catalyze sustainable development. This conference is taking place at a very suitable time as countries in Africa and beyond seek to address three interlinked crises: climate change, biodiversity loss, pollution, which all affects economies and investments, health in Africa, but also globally. In the recent years, it's very clear that extreme weather phenomena such as rising temperature and increasing frequency of droughts and floods are affecting lives and livelihoods on this continent and this region in particular. According to the Global Climate Risk Index in 2021, among the top 10 affected countries, 5 were in Africa, including South Sudan, Zimbabwe, Malawi, Mozambique, as you remember the crisis that happened there a couple of months ago. More importantly, in our region, we have witnessed unusual floods and landslides and droughts and other disasters which affected development infrastructure and investments. In addition, these have disrupted significantly the supply chain, increased the refinancing risks, and default by businesses. The negative societal effects of climate change, such as loss of life and livelihoods, are already and will continue to be tragic and severe, and are a key concern to government, investors, and individuals. And more frequently, we have seen again a delayed transition in low carbon economy, and this will continue to affect significantly or bring impact to material financial losses with potential systemic consequences for financial stability on this continent and this region in particular. IUCN believe that nature is a cornerstone to making investments and people resilient. In Kenya and in Africa, our work as an organization aims at improving resilience of people and investments through sustainable biodiversity and natural resource management in partnership with governments, research institutions, non-state actors, and private sector. We recognize that private sector, including banks and insurance companies, play a critical role in determining how biodiversity is used and conserved. And there are clear benefits to businesses on improving environmental and climate risk management performance, such as reduced costs, improved innovation, and increased likelihood of regulatory approval, topics that matter for this conference this year. IUCN, with financial support from Mitsubishi Corporation Fund for Europe and Africa, have been working with KBA to create awareness and building capacity of the banking sector on sustainable financing principles, and will continue to do so, working with KBA and other financial institutions to continue deepening this topic. As a knowledge and science-based organization, IUCN have invested significantly in developing nature-based solutions standards, both for public and private sector institutions, which could inform investments, provide opportunity of understanding the risks, but also the return on investments for such investments. We have also been working very closely with private sector to establish what we call coalition of private investors in conservation, which helps mostly develop principles, guidelines, but also provide a metrics to investors to measure how much the investment will contribute to both climate and biodiversity safeguards. We cannot underestimate the role of central banks and financial regulators in promoting conservation, but also sustainable development with the broader outcome of building a more sustainable financial sector. Inclusive green and sustainable finance policies approach that incorporate climate change, biodiversity, and related nature-based solution can help reduce and manage natural disaster risks. Tools such as the IUCN Global Standards for Nature-Based Solutions can facilitate the transition. And we'll be very happy to continue working with KBA to put more research into this topic to help financial institutions to thrive and be more resilient. In the coming years, IUCN will continue to work again with financial institutions, especially in East Africa, as we establish what we call East Africa Sustainable Finance Hub, a project that will start next year with financial commitment from the USAID. And this will help develop a pipeline of investable deals that can at the same time address climate change, biodiversity loss, pollution, but also raise awareness in line with sustainable finance. IUCN is committed to this collaboration with KBA and other key partners in this endeavor in jointly developing solutions to the interlinked crisis, and that affects the humanity in a broader sense. We commit to continue working and supporting this initiative. More importantly, the research, provide our inputs into the process, but also mobilize our broader scientific community, what we call commissions of 15,000 commission members who are very much into different research topics, to work with the KBA across the region in continue delivering this particular conference. With this view, I want to thank you for your understanding.
Thank you, Charles. And thank you for agreeing to join us today and shed some light on the topic of sustainable finance in particular, and how we can, as a banking sector, as a financial sector, really put in policies and approaches that ensure we have sustainable financing. It is now my pleasure to invite our chief guest, Dr. Julius Muya, to make his remarks. Thank you.
Good morning, everyone. Morning again. Thank you. Let me stand on the protocols that have been established already in terms of recognizing those who have been very key in organizing this forum, and especially my friends for a long time on this table that I have met before in different fora. And so let me just go straight to what have been requested to come and present here. And I want to say I am really grateful that once again, KBA, you have invited me to grace the opening ceremony of this 11th Kenya Bankers Association Annual Banking Research Conference. as indicated earlier by Daktari and also Bwana Kiara Maina, I was actually with you not long ago when we were talking about SMEs. And so let me at the outset commend KBA for organizing and convening this annual research forum, conference, meeting, and where I stand, I am actually convinced that the sustained interest in this convention over the years continues to demonstrate a commitment by a wide range of stakeholders to collaborate towards creating what is key nowadays, that is evidence-based solutions for a multiplicity of emerging challenges in the banking sector in particular, but also in the financial sector at large. I'm actually very excited to have heard that we have over 200 participants who have logged in, and this is actually quite commendable because we are now exploiting technology to be able to link up with as many people as possible. And so I want to say that I note that this year the conference seeks to examine the banking industry dynamics in the context of technological and financial innovations, as well as sustainability, which Charles, actually you have done a lot of justice in bringing out the issues about nature, about biodiversity, and the issues about sustainability, and especially as we relate nature to financing. So in my view, this subject aligns very well in terms of other key emerging developments and the topical discussions in the financial services sector. I think I would be right to say both locally in the country, in the region, that is the East African region, but also from the global perspective. Now, I think I need to reflect on a few things as we go in this discussion so that we can put things in perspective. First, noting about Kenya as a country, that we have a long-term development print. That blueprint is the Vision 2030, which is anchored on 3 pillars, just to remind ourselves. We have the economic pillar, we have the social pillar, and the political pillar. And where we find financial sector is the economic pillar, where in the economic pillar, the vision is for the financial services sector to create a vibrant and globally competitive sector. And this sector, which is both vibrant and globally competitive, should create jobs and promote high levels of savings to finance Kenya's overall investment needs. Indeed, the role of the banking sector, therefore, cannot be overemphasized. And we can discuss about this, we can do a lot of research just to show how the banking sector plays a very critical role in terms of anchoring the economy, both from the economic side of things, on the social side of things, and also even political stability. The banking sector plays a very, very big role. And so, just to reflect a bit on Vision 2030, we have been implementing this one through 5 successful medium-term plans. So the vision has created what I would call an enabling environment that has seen the financial services sector grow from strength to strength year on year. Also, the Vision 2030 framework provides for a continuous review of the architecture for regulating the financial services sector so that we can keep pace with its growth and also evolution, as well as ensure that its stability is maintained. So currently we are transitioning from the 3rd medium-term plan to what we call the 4th medium-term plan, which is for the period from 2023 to 2027. And I want to say, from where I stand, that the National Treasury acknowledges the inputs by the banking sector on a number of areas under the Financial Services Sector Working Group, which I am really happy that KBA and quite a number of you do participate in, and which have been privileged to chair. So if I can just pick a few of the invaluable inputs that we have received. One of them is identifying the avenues for enhancing credit growth. Also, access and utilization. And that to me is a big thing because credit helps in terms of business growth and also in terms of investments. The second one among the invaluable inputs is growing the adoption of fintech and digital financial services, which again, the reflections from this 3 days conference should help a lot in terms of bringing out to light things that we should be putting in the fourth medium-term plan, especially in the financial services sector. Then finally, enhancing the financial sector overall competitiveness. And when we talk about competitiveness, this is big stuff because for you who are aware about the Global Economic Forum, where they monitor and check countries' competitiveness, it is important for us to appreciate what they look for in terms of potential investments that are being made in various countries, because they look at the competitiveness of that economy. And the area of the financial services sector is one such area where we have to focus on. And so for me, I'm really pleased to note that some of these areas form part of the research output that is due for presentation and discussion in this conference. So well done, Daktari, for actually thinking through, theming what we are going to be hearing in the next 3 days. So judging from the theme of this conference, I have no doubt that discussions for the next 3 days will be both insightful and also thought-provoking. Also, based on the itemized program, which I've had the privilege of having a look at, I am persuaded to believe that the research presentations will be very helpful in enhancing our understanding of the banking sector by presenting innovative interventions that are geared towards improved efficiency within the financial system, as well as promoting good customer experience. I particularly note that a large number of the papers will delve into climate finance on issues of mitigation, that is to reduce the emission of greenhouse gases, that is mitigation, and also on adaptation, that is how businesses and people are coping with climate change. It is important for us to differentiate between the two: mitigation, reducing the emission of greenhouse gases; adaptation is how you cope with climate change in your daily life as a business, as a people. And that is what our friend Charles has spent some time bringing out. So this thematic focus area of climate change is actually quite topical, and it resonates very well with the global clamor for the adoption of lending practices that seek to address long-standing climate-related concerns and risks. Indeed, it is an area that should be accorded more attention by the financial services sector in light of the inevitable need to entrench sustainability in lending and business operations. And so, KBA, I want to laud you for delving into this area and choosing to build your knowledge and our knowledge base on sustainable finance, and also highlighting the need for the sector to align with global trends. While I am on this subject, just allow me to dig in a bit on the area of climate finance. And I want to share some metrics that can be useful to provide some basis for framing our discussions in the next 3 days. Let me repeat that. I want to say a few things on climate finance, which is also sustainable financing, so that we can share some metrics that can be useful to frame our discussions in the next 3 days. And the basis of this, I want to be very honest with us, is a meeting that I attended last week in Cairo. So this is a meeting that was organized for the ministers in Africa of finance and environment. And I was there with a delegation from the National Treasury as the head of the delegation to represent my minister. And basically what we were doing was to look at this area of sustainable financing. And also asking ourselves, when we go to COP27, hands up those who are aware about some animal called COP27. Yeah, we've got a fair number. So there's this climate change meeting that is planned in Egypt in November this year. It's called COP27. COP26 was in Glasgow last year, and COP25 was in Madrid in 2019. So anyway, specifically what we're looking at is what will be the voice of Africa when we go to COP27 to meet the other countries of the world. And one of the things that was very clear is the lack of fairness in the financial sector. This lack of fairness is presented as follows. Africa is home to 17% of the world population. Take that number somewhere. Yeah, 17% of the world population resides in Africa. But Africa attracts only 3% of global sustainable funds. 17% of the population, we only attract 3%. Can you see unfairness? And so the question that I want to pose to us, and as we think about our conference the next 3 days and also some other future research areas, is what can we do to increase Africa's share of sustainable financing? And when I say Africa, substitute Africa with the region. And you can also be a little bit more selfish. You can substitute the region with your country for those who are here and those who are listening virtually. But you can also be selfish. If you come from a bank, you can also go down and ask yourself, how can we increase our share of sustainable financing as a financial institution? For me, because I come from the public sector, my question is, how can we increase our share as Kenya in terms of public finance in that space of sustainable financing? So that is an area for further research, Daktari, that I want to present to ourselves. But I want to say also, having this discussion is very important because Africa bears the brunt of climate change. Now, for instance, despite the fact that Africa receives only 3% of sustainable financing, we also recognize the fact that Africa suffers in terms of GDP reduction because of climate change. Between 5 and 15% of our GDP is reduced because of climate change. So again, another area to worry about. But another area also to worry about is that Africa only contributes about 3.8% of greenhouse gases globally. Our contribution in terms of greenhouse gases is very low. And so really, what do we need? We need to undertake a lot of research to inform necessary reforms so that we can attract sustainable financing, and especially sustainable financing that can help us with adaptation and also that can help us with resilience. And specifically for Kenya, we are very disadvantaged. And I say why? Because about 84% of Kenya is arid and semi-arid. I want to repeat that. About 84% of Kenya is arid and semi-arid. And the indications from the climate change observers is that that situation of lack of rainfall, that situation of extreme temperatures is getting worse and worse and worse. So if that situation then is getting worse, then we need to get more funds so that we can be able to stem that worsening situation. And that calls for especially adaptation and resilience financing. So things that we need to ask ourselves as we go. I want also to add to that when we also look at the flows of sustainable financing, and if you can just divide them quickly between money for adaptation and money for mitigation. Or let me start with mitigation and then adaptation. Most of the money for climate finance goes to mitigation, reducing the emission of greenhouse gases. But did I say that Africa contributes very little in terms of greenhouse gases? So about 90%, actually 93% of the global sustainable financing goes to mitigation. It's only the balance of about 7% that goes to adaptation. So what do I want to say? I want to say we need to think very, very clearly and very carefully in terms of our research agenda on how, as we are looking to attract sustainable financing, how to target the little sustainable financing for adaptation that is availed there. So again, very serious areas for research that I want to say we could also be thinking about because this helps to understand the volume of finances that is available in our region. Now, the last point that I want to share in this kind of like macro setup is that when you employ a public finance lens, there's another monumental challenge which I want us to be aware about. And this is the cost of public debt, which of course informs a lot of metrics within your area of the financial sector. And so from recent statistics, the indication is that for developed countries, the average cost of public debt, that is when government borrows, is about 1% per annum. So for developed countries, their countries borrow at an average of 1% per annum, externally. For developing countries, the figure is 3%. We moved from 1% to 3%. So which means that developing countries have to look for more money to service their debt, which is 3 times what developed countries have to fork out to service their debt. Now, when we come to Africa, it gets worse. The average cost of external debt in the public sector for Africa is 8%. My brothers and sisters, compare 1% with 8%. Now, part of the reason, and that is why I'm sharing this with us here, is that the high cost of debt and capital for developing countries and Africa is because of an animal called risk perception premium on debt. I'm aware we have papers on risk, and one I want to persuade us is to go a little bit deeper and look at risk at a higher level. I know we are looking at risk at the banking sector level, but those guys who provide finance from outside, which informs the cost of money in the country in a way, they also look at our risk as a country. And so I would request us, as we do our research, to also think about risk at a national level, yeah, at sovereign level, because that in a way has an implication and an impact on the risk that you are looking at the micro level of project loans and financing of credit. And part of this risk premium, which is actually a perception risk premium, is actually because a mispricing occurs because of inadequate data. The mispricing of risk because of inadequate data. The mispricing of risk because of inadequate parameters, or parameters that do not capture what the providers of capital at the high level of the guys, the fund managers, the guys who have a lot of money, what they look at. A mispricing of risk because we don't have good evidence in terms of how we are able to service our loans, how our borrowers are good borrowers in terms of how they are repaying their loans. And so really, as we are engaging and doing our research, let's also ask ourselves, what financial products can we have that deal with this mispricing phenomenon, and also this perception premium of risk, or rather perception risk premium in Africa. And one can think about great things like I think Charles has indicated in a way where we call for debt for nature swaps. Those are things that are coming up in terms of new financial products that are being thought about. Some countries have already taken advantage of this. Seychelles and another country called Belize have taken advantage of debt for nature swaps. Also, the de-risking of projects. I mean, how well do we use institutions that provide risk, de-risking products like Africa Trade Insurance? Hands up those who have heard about ATI, Africa Trade Insurance. This is less than a fifth, actually. 10% of us here have heard about Africa Trade Insurance. Let me put it differently. 90% of us have not heard about Africa Trade Insurance. And Kenya is one of the major sponsors of Africa Trade Insurance. And its work is to de-risk a lot of times projects and funds that are being availed and borrowed in the region. So looking for de-risking of projects, so that projects that, looking at them look like they have high risks, we are able to reduce those risks by taking risk insurance. And finally, of course, the whole area of how well do investors, the guys that you finance, the borrowers, how well do they prepare and develop their projects? I think those of us who have been in the area of credit department, you know how we struggle to look at projects that have been presented by potential borrowers. One of them, you look at it, it is a good project, but it has been prepared so badly, such that as a banker, you feel like telling the guy, bring it here, I write the project proposal for you. So this is also another area where we should also think about in terms of how we can ensure that the projects that are being presented to the banks have been prepared in a way they are bankable, and therefore they don't expose the borrowers to unnecessary risk. So the long and short of what I've said is there's a lot that we can do in this area of sustainable financing. And I want to encourage us, and I will be talking separately to the leadership, so that we can think about how can we participate in COP27 as a region, as a country, on the areas of sustainable financing, so that we can attract the kind of monies that they are talking about out there, and especially to deal with our situation of climate change, our situation where there's great need for us to get money to deal with adaptation and also resilience. And so, having digressed a bit and built the framework of some of the global things that I would like us to think about, let me just say a few things about what I have seen in our banking sector that I note from the KBA's State of Sustainable Finance in Kenya's banking industry report that over 85% of our commercial banks in the country have had their credit policies aligned to ensure there is responsible and sustainable lending practices. However, there remains a lot to be done to understand climate risk. This is an evolving area so that lenders as well as any practitioner in this area can ensure that they have got good grounding and understanding of climate risk. Let me also commend KBA for deliberately championing and coordinating capacity building on green financing among bank staff and the Sustainable Finance Initiative. I'm told quite a number of officers and employees have been trained in this area. And if I can revisit something that I've said earlier on, the ability to develop, to prepare bankable projects is very important. In fact, in that meeting that I attended of African ministers, that came out as one of the single largest challenge of attracting sustainable financing in this region. So we might as well look for ways in which we can spend more time and just make sure that there is very clear understanding and framework of how we capacity build our people, both the bankers themselves who do that credit evaluation, and also the maybe consultants who help investors to write investment proposal, or even engaging with the private sector bodies like in Kenya we have KEPSA, to engage with them so that they can know what are the basic requirements to prepare a sensible and a bankable sustainable project. So let me challenge us as I go to leverage on this research forum to generate credible evidence and analysis, as well as continuously collect and analyze data to enable us to structure and roll out sustainable financing products. Certainly, it is true that robust evidence on climate-friendly finance and enhanced quality of climate-related data will be very critical in enabling policymakers, and I say so because this is what I spent my day and my time in government doing, so that us as policymakers can be able to use this to support initiatives and achieve green finance targets that we've set ourselves in terms of the national determined contribution NDCs that we have set for ourselves. So friends, I'm about to finish. So I want to reflect and say that the Kenya economy since independence has always been accompanied and also associated with expansion and diversification of the financial system, which has undergone what I would call tremendous transformation over the years. I want to say part of this research and a good part of the output from the presentations will help us to build this transformation that is important in our financial sector. We recognize that we have had major reforms and regulatory initiatives that have been undertaken in the financial sector, and this of course has helped a lot to enhance financial stability. This has also helped a lot to promote efficiency and also access to financial services, which have gone a long way in making the sector much stronger. So these reforms are what have enabled us in the region to be able to deliver one of the most developed banking systems in Africa. So I want to encourage stakeholders here today and those who are participating virtually to continuously engage in consultations on progressive policies to ensure favorable outcomes for the economy at large. It will be helpful, for instance, to continue exploring options for banks to diversify their portfolios and also achieve significant economies of scale, and also the adoption of technologies that not only introduce efficiency gains, but also support banking sector resilience. The whole area of evidence to action is very commendable. The whole area of research to inform data, to inform evidence, to inform policy, to inform action is really very commendable. But may I ask, is there a way then that we can look back at the last 10 conferences and do a further research to find out what has happened to the evidence that we got from those researches? That can be even be a PhD paper where one can actually do a thorough study to do some tracer study on how much of that evidence has led to policy change, which of the findings have not found anywhere to inform in terms of policy or in terms of strategies or product design in the banking sector. And for that reason, why have we not been able to utilize that information? Because knowledge is only useful when it is shared and when it is applied. With those many remarks, let me wish all of us a very, very exciting time. And it is now my singular honor and pleasure to declare this conference officially opened as we continue with the deliberations. Asante sana. God bless us all. Thank you.
Thank you so much, Bwana PS, and for challenging us to, in so many ways, to be part of the solutions that we so wish we could get for the industry. So thanks a lot for finding time from your very busy schedule to be with us and gracing our occasion and giving us insights. I always listen to you keenly whenever you're speaking, because out of what you always say, you generate work for us researchers. And we've taken note of the need to look back and say the extent of adoption of some of the evidences generated from our research. Definitely that's something that I want to promise. We will have a publication around that, and just to review how far we have come. So thanks a lot for inspiring us in many ways. So at this point, in the interest of time, while we are keen to host the PS, even through the presentations that are coming up, we have 3 papers lined up for us today. While we are keen that we would be very much honored to have you listen to some of the papers in here and even give feedback on them, we also acknowledge that your busy schedule is something that we take note of. So I would want to invite us for a small session where we take pictures, because we always like to remember our occasions, Bwana PS, and as we remember, we would want to take memories with us to the future through some photos. With the governing council members of KBA, and researchers, discussants who are here today, we invite us to take some few pictures out there. I think we would be guided when you get there. Okay. I'm guided that we can take the pictures in here. Then as we take 10 minutes break just for that session, then we will resume to take up the presentations of the papers soon after that. So Thank you, and I invite PS and Bwana Kihara, Mr. Charles, and Habil for a photo session, and the GC members here present today. Karibuni sana. Yes, the CEOs here present today, together with their representatives also. Please be part of us. So, thank you. So the next group is discussants and researchers who are here, the authors of papers who are here, and discussants. Please join in the picture.
But I listened to your speech very clearly.
Yeah. Thank you.
I really look forward to.
Sorry. Hold on.
So I invite us to 10 minutes break as we take tea, then we gather back at 10:30 on the dot to progress with the rest of the program. So tea is served right outside the door.
Tunasonga mbele, hakuna hatua mpaka twende sote. Maadili, kujituma kweli, uongozi Kenya ifike kilele. KBA, 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 at 60 KBA.
The Kenya Bankers Association was registered as a trade union. The date was 16th of July 1962. At that point in time, the essential role that the industry association was to play was to facilitate industrial relations, thus by negotiating the terms and conditions of service for the unionizable employees. But over time, the role of KBA has evolved. There was amendment to the KBA mandate, where it was expanded to include promoting industry development, engaging with the various policy stakeholders, which is essentially the government, the regulator, and other stakeholders in the policy environment.
The Kenyan banking sector is one of the most vibrant in the region. I don't know if people know, but the assets of the banking sector to GDP is about 48%. In other words, the ratio of assets to GDP is about 48%. So we are a very big part of the banking sector. More importantly, when you look at 2019 and 2020, the banking sector share of taxes collected in the country was 27%. So 27% of taxes collected in this country came from the banking sector. Besides that, I think after government, the banking sector is the second biggest employer.
As an industry leader, I take pride to be associated with the inspiring strides the industry has made in the past few decades. I continue to be particularly inspired by the industry's continuing commitment to deepen financial inclusion for all, including women, the youth, and persons with disabilities.
I believe that the banking sector has played a significant role in the development of the economy. When you look at it from a corporate perspective, as banks provide access to credit and credit facilities, they provide opportunities for employment, and we've seen numbers of employment increase by virtue of the access to credit that's been made available.
My 60th anniversary message is threefold. One, as we turn 60, is to thank the banking sector for having come together and continuing to work together under the umbrella of the Kenya Bankers Association. We remain a model banking organization, and a lot of countries do visit us to see how we operate together as KBA. Secondly, is to say that we shall continue to work together with our regulators and with the government to foster economic growth for the country. And to say the third message is to urge the banking sector to continue supporting the various initiatives that we put forth. And as we turn 60, we should be proud that we continue to play that role to ensure that economy and our people progress.
KBA, 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 at 60, KBA, one industry, KBA, transforming Kenya. Tunasonga mbele, hakuna hatua mpaka twende sote. Maadili, kujituma kweli, uongozi Kenya ifike kilele. KBA, 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 at 60, KBA.
The Kenya Bankers Association was registered as a trade union. The date was 16th of July 1962. At that point in time, the essential role that the industry association was to play was to facilitate industrial relations, thus by negotiating the terms and conditions of service for the unionizable employees. But over time, the role of KBA has evolved. There was amendment to the KBA mandate, where it was expanded to include promoting industry development, engaging with the various policy stakeholders, which is essentially the government, the regulator, and other stakeholders in the policy environment.
The Kenyan banking sector is one of the most vibrant in the region. I don't know if people know, but the assets of the banking sector to GDP is about 48%. In other words, the ratio of assets to GDP is about 48%. So we are a very big part of the banking sector. More importantly, when you look at 2019 and 2020, the banking sector share of taxes collected in the country was 27%. So 27% of taxes collected in this country came from the banking sector. Besides that, I think after government, the banking sector is the second biggest employer.
As an industry leader, I take pride to be associated with the inspiring strides the industry has made in the past few decades. I continue to be particularly inspired by the industry's continuing commitment to deepen financial inclusion for all, including women, the youth, and persons with disabilities.
I believe that the banking sector has played a significant role in the development of the economy. When you look at it from a corporate perspective, as banks provide access to credit and credit facilities, they provide opportunities for employment, and we've seen numbers of employment increase by virtue of the access to credit that's been made available.
My 60th anniversary message is threefold. One, as we turn 60, is to thank the banking sector for having come together and continuing to work together under the umbrella of the Kenya Bankers Association. We remain a model banking organization, and a lot of countries do visit us to see how we operate together as KBA. Secondly, is to say that we shall continue to work together with our regulators and with the government to foster economic growth for the country. And to say the third message is to urge the banking sector to continue supporting the various initiatives that we put forth. And as we turn 60, we should be proud that we continue to play that role to ensure that economy and our people progress.
KBA, 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 at 60, KBA, one industry, KBA, transforming Kenya. Tunasonga mbele, hakuna hatua mpaka twende sote. Maadili, kujituma kweli, uongozi Kenya ifike kilele. KBA, 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 at 60, KBA.
The Kenya Bankers Association was registered as a trade union. The date was 16th of July 1962. At that point in time, the essential role that the industry association was to play was to facilitate industrial relations, thus by negotiating the terms and conditions of service for the unionizable employees. But over time, the role of KBA has evolved. There was amendment to the KBA mandate, where it was expanded to include promoting industry development, engaging with the various policy stakeholders, which is essentially the government, the regulator, and other stakeholders in the policy environment.
The Kenyan banking sector is one of the most vibrant in the region. I don't know if people know, but the assets of the banking sector to GDP is about 48%. In other words, the ratio of assets to GDP is about 48%. So we are a very big part of the banking sector. More importantly, when you look at 2019 and 2020, the banking sector share of taxes collected in the country was 27%. So 27% of taxes collected in this country came from the banking sector. Besides that, I think after government, the banking sector is the second biggest employer.
As an industry leader, I take pride to be associated with the inspiring strides the industry has made in the past few decades. I continue to be particularly inspired by the industry's continuing commitment to deepen financial inclusion for all, including women, the youth, and persons with disabilities.
I believe that the banking sector has played a significant role in the development of the economy. When you look at it from a corporate perspective, as banks provide access to credit and credit facilities, they provide opportunities for employment, and we've seen numbers of employment increase by virtue of the access to credit that's been made available.
My 60th anniversary message is threefold. One, as we turn 60, is to thank the banking sector for having come together and continuing to work together under the umbrella of the Kenya Bankers Association. We remain a model banking organization, and a lot of countries do visit us to see how we operate together as KBA. Secondly, is to say that we shall continue to work together with our regulators and with the government to foster economic growth for the country. And to say the third message is to urge the banking sector to continue supporting the various initiatives that we put forth. And as we turn 60, we should be proud that we continue to play that role to ensure that economy and our people progress.
KBA, 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 at 60, KBA, one industry, KBA, transforming Kenya. Tunasonga mbele, hakuna hatua mpaka twende sote. Maadili, kujituma kweli, uongozi Kenya ifike kilele. KBA, 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 at 60, KBA, one industry.
The Kenya Bankers Association was registered as a trade union. The date was 16th of July 1962. At that point in time, the essential role that the industry association was to play was to facilitate industrial relations, thus by negotiating the terms and conditions of service for the unionizable employees. But over time, the role of KBA has evolved. There was amendment to the KBA mandate, where it was expanded to include promoting industry development, engaging with the various policy stakeholders, which is essentially the government, the regulator,
papers lined up for this morning. And our first paper is on risk-based credit pricing in Kenya, the role of banks, internal factors. The second paper is on fintech and bank stability in a small, open economy context, the case of Kenya. And then our final paper for this day is on climate change, climate policy relevant sectors, and banking sector stability. So we'll take you through the first paper, and which is prepared by the Research Department of Kenya Bankers Association, again for your input in terms of comments, reviews, for purposes of incorporation in the final paper that would be then published as a KBA working paper series. So my name is Samuel Tiriongo, and I'm representing the association's research department, and co-authors Josiah and Hilary are here with us, and would be keen to listen to your comments on this as we shape the paper going forward. So the paper is on risk-based credit pricing in Kenya, the role of banks' internal factors. The outline of the presentation is such that we'll have a brief background, then a review of some of the stylized facts, a review of the literature in brief, the methodology, and a discussion of the results, drawing some policy implications coming out of the paper. So as a way of background, credit mispricing, and happy to note that this was also in the mind of the chief guest today when he talked about the dangers of mispricing. Credit mispricing definitely, now that I'm talking to bankers mostly and financial sector players mostly, has serious implications on the volumes of credit that would be extended to the entire economy, and therefore it becomes a concern to us. Why we need to discuss the matter of pricing. We acknowledge that from literature, and I think it would also be acknowledged here amongst many of us, that high interest rate constrains access to bank credit, and of course our financial inclusion objectives would also fall behind. But too low interest rates, on the other hand, also have serious implications because it pushes lenders to start rebalancing their portfolios towards trading and other fee-related activities. Because again, they are profit-maximizing agencies at the end of it all. So the question then is, what is optimal? What is good pricing? What is that pricing that reflects conditions in the market, that reflects a fair supply-demand interactions in the market? One that would encourage financial inclusion on one end, and another to also encourage lenders to lend at the other end. So the question of policy interest is what actually drives the cost of credit. And as we look at this, we also are keen to note the mitigations, the policy measures that have been taken around this subject matter. Okay, thank you. The mitigations and the policy measures taken around this subject matter, just to be able to encourage the uptake of credit through incentives via the price. So a journey through from 1991 to date, of course, we have come a long way from the predetermined lending rates and saving rates in the 1990s, beyond the liberalization that came in 1991, towards some of the measures that have been taken that actually include the innovations around the credit information sharing with the issuance of the banking regulations in 2008. Then the publication by the central bank of the Kenya Bank's reference rate, as well as the total cost of credit, innovations around the total cost of credit and the annual percentage rate. So all these were geared at supporting a pricing environment that is, one, reflective of market conditions, so that there is no mispricing after all. Then came the 2016 interest rate capping period, where now we, through a private member's bill in Parliament, we the banking sector was faced with interest rate capping. From 2016 all the way to November 2019 when it was repealed, we were operating under an interest rate capping regime. And soon after, as the sector was exiting from interest rate capping, then came the banking sector charter, whose pillars actually included risk-based pricing. So to date, we are in that space of transitioning to risk-based pricing environment. And as we do this, of course, there are some outcomes that have already been noted. Quite a number of banks now have close to half of the banking sector in terms of numbers, not necessarily in terms of volumes of credit, have had their risk-based pricing models approved by the central bank. But as an outcome, of course, looking at the chart on the right, is that we actually see a lending rate that has sluggishly declined over time from the mid-90s to date. But of course, the disruptions is not something that we can ignore. The interest rate capping came into place, which actually gave us a feel that the interest rates were not going to change for the long haul because we were in a capping situation, and therefore there was a minimal adjustments in the lending rate. But the risk premium also, the dotted line, is actually also a reflection of a gradual decline. When you look at the comparison between lending rate and treasury bill rate, which is deemed to be a risk-free rate, not so much remarkable reduction in the risk premium, which is something that, again, the chief guest alluded to. We need to dig deep and look at what is these drivers of risk premium that appears so high when we consider our type of markets. So the policy concern, particularly on risk pricing, which is actually reflected in the cost of credit, is that in principle, we would imagine that interest rates should actually reflect risk conditions in the market. That is, I think, something that all of us would agree with. But this has implications on the borrower's access to credit at the end of the day. So while at this point, the point of concern is, are the interest rates reflective of the risk conditions in the market? Ideally, an increase in the cost of financial intermediation, particularly due to operating costs or other credit risk escalation, would be reflected in a higher lending rate. That is a typical well-functioning market. That should actually be seen. Because at the end of the day, with the higher interest rates, definitely banks would be seeking to recoup the costs that come with increased cost of doing business. However, there is less emphasis, particularly in literature, in looking inward, particularly for banks, because there would be some bank-specific drivers of interest rates that we are keen to highlight on, because at the end of the day, it's not only the operating environment which is defined by the policy environment. There are also inward-looking factors that actually drive interest rates. So the question that we are asking in this research is that, do banks' internal policies or factors matter in credit pricing? And if so, to what degree? So the study objective for this study is really to assess the role of banks' internal factors in influencing credit pricing, particularly at a time when we are into that high gear of operationalizing the credit risk-based pricing frameworks in Kenya. So looking at some stylized facts, of course, the top left panel, for those who are able to see, is actually a reflection of the journey through interest rates over time. And we still see that spreads remain high. Interest rate spreads remain high because lending rates have remained high, above 10% for a considerable period of time. Actually, since 2012, we've not seen lending rates come below 10%. And again, on the left-hand panel, because we are also interested in looking at the cost structures for banks, and particularly the cost-income ratios. The cost-income ratios, again, remain high, reflective of the cost of doing business, particularly for the banking sector. And this is an input into the pricing mechanism at the end of the day, because with elevated costs, definitely you would want to price that into the loans that we extend as a banking sector to the economy. But also other issues that are of interest is really the market structure, because concentration has dynamics. Concentration in terms of assets, concentration in terms of deposits, concentration in terms of the critical parameters that define lending in the banking sector is very important. So we have assessed concentration in terms of assets, because that is one of the driving factors in lending. So concentration levels reflect a competitive structure so far. And of course, all of us here as analysts would agree that a competitive structure is supportive of a market that would actually reflect competitive interest rates. So to a large extent, we still see competitive market structure that then is not expected so much to alter the pricing conditions in the market, but we'll see the results as we go along. Then credit growth remains lackluster over the period, and of course this is again reflective of some market dynamics, including even other factors such as the cost dynamics that have emerged, and now the pandemic, effects of the pandemic that then deteriorated the credit risk to levels to warrant a reaction and an adjustment in the banking sector and the lending. Then in terms of literature, just a summary of some of the factors that influence credit pricing is that we would have banks' idiosyncratic attributes, the unique attributes to banks. Would also have industry structure as driving factor, and the macroeconomic environment as the broad areas of focus that actually are reflected in credit pricing. But bank size matters, particularly for large banks. They're able to enjoy what we call the economies of scale, and that can actually be reflected in the pricing of credit. Then credit risk dynamics also have a role, and the ability and capacity to mobilize deposits also has a bearing in influencing the cost of credit. Then banking industry dynamics in terms of concentration, particularly of assets, is also something of great interest. Then macroeconomic factors such as the performance of the economy in general, as well as inflation, are some of the key factors that emerge from literature. And we are also keen to test this for the case of Kenya. So in terms of methodology, we pursued a panel data model that used 38 data from 38 banks on audited financials, annual results from 2003 to 2021. And as we followed this model, of course, we are saying lending rate is a function of several factors. One is a vector of bank-specific variables, which is what our interest is on. This, I'll be detailing again, these bank-specific factors. Then time-varying banking industry-specific variables, again, dynamics around concentration, and others are the macroeconomic factors. So we are keen to know to what extent these factors affect pricing, and now draw some conclusions in the light of the credit risk-based pricing models. Again, due diligence in terms of modeling, panel regressions, Hausman tests to choose the best model that we are going to interpret today. So we take this through analysis, and we can see several factors coming in at an industry level. But also we went ahead to say, can we disaggregate the banking sector? Because the behavior of Tier 3 banks may not necessarily be the same as the behavior of Tier 1 or Tier 2 banks. So we list out some of the factors that influence credit pricing. On the left-hand side, we have credit pricing. On the right-hand side, we have bank size, which is actually measured by the logarithm of bank assets. I will not go into those details. But ideally, we see that as bank size goes up, then there is a tendency at an industry level for cost of credit to go down. So again, making mention of the economies of scale, the benefits that come with scale operations, particularly for the industry. And credit risk also, an escalation in credit risk also pushes up lending rates quite significantly. And also the deposits mobilization. Again, here is a reflection of the capacity to mobilize deposits then would be driven by the cost of funds. You need to put in a price that is attractive to customers for you to be able to generate higher deposits. And that's why the higher the deposits, then you need to charge higher rates of lending for you to recoup the higher cost of mobilizing the same deposits. Cost to income ratios, which is again a reflection of the costs that banks have to face even for them to realize that particular income that they generate at the end of the day. Again, pushes up lending rates to a greater margin. So we see credit risk playing a stronger role at an industry level, followed by the size of the bank, and then followed by the capacity to mobilize deposits. So and then again, finally, now we have cost to income ratios. Now the dynamics around the concentration, which is measured by the HHI index, is such that at an industry level, we don't see that at play. And perhaps that's also an indication and an endorsement that since we have, we had that conclusion that the market structure is more or less reflective of a competitive structure. So the dynamics around competition are at play strongly and are not necessarily reflected in the pricing conditions, if we look at it through the lens of the concentration of assets. GDP, again, the performance of the general economy is not so strong. It has an impact, but not so strong in terms of influencing pricing of credit. Then inflation rate, the same. So there seems to be a stronger impact of factors that are within the operational space of banks, like when you talk about asset buildup, when you talk about credit risk, we have, as an industry, control over the management of credit books, as well as our strategies around the deposits mobilization and also management of the cost structure. Now, we did this analysis at an industry level, but also went into each of the tiers. And it's interesting to see that some of the factors that are critical at an industry stage are actually falling off when we start looking at each of the individual tiers. And bank size, for instance, appears to be quite strong in terms of impact at tier 3. So there is quite a significant move that should a tier 3 bank, for instance, alter its size, it has a stronger impact on its lending capacity and also in pricing of loans compared to a movement on the tier 2 or tier 3. Again, these dynamics are at play, so those that have stars on them are the significant factors. So credit risk at an industry level plays a key role, but now when we move to tier 1, tier 2, tier 3, we see that it's stronger in tier 3 and tier 2 and not in tier 1. Again, because of what I mentioned about the economies of scale, large banks are able to absorb credit losses with much ease compared to their smaller counterparts. So this is the same. So we see dynamics that when you look at an industry as whole, it reflects slightly different views compared to when you zoom in into one of the categories, such as tier 1, tier 2, or tier 3. So this is a pointer to something that has implications on risk-based pricing, because then the question that we would be asking ourselves, should we have a one-size-fits-all model? Can we copy and paste models that are generated from one bank to be actually used across the banking sector? That's a question that then we get answers today, that it appears that when we drill into one of the categories of banks, the dynamics are completely different. And would also be very keen to get feedback from the bankers here in today, even as we look inward further to individual bank level. Do we have a chance that the results that we are seeing here, reflective of the industry, do they match what we see at our individual bank level? So as a way of conclusion, of course, we see the role of bank-specific factors influencing credit pricing. But it also matters where we are at any given time. Are we in Tier 1, Tier 2, or Tier 3? We have a chance, again, to escalate this to an individual bank level and say, to what extent do we see this at play in influencing credit pricing? Asset-based concentration also matters, particularly for certain classes of banks. Like, for instance, large banks enjoy economies of scale that can affect their ability to drift their pricing conditions away from what others are doing. Then macroeconomic factors, we don't see them quite strong. But one thing that emerged is that the role of GDP outturn, particularly for the smaller banks, is disproportionately more compared to the other banks. And that, of course, has an interesting conclusion attached to it, because the Tier 3 banks would be more exposed to market conditions, changing market conditions, than the Tier 1 or even the Tier 2 banks. So it's of interest for Tier 3 to monitor market conditions more and of course adjust accordingly in line with market conditions, particularly in the performance of the economy. So while we assess these results, of course, we can conclude that it makes sense to pursue bank-level credit risk pricing model and not an industry-level credit risk models, and that there is no one-size-fits-all model that can be applied in risk-based pricing. So it's important for banks to look inward to be able to generate their pricing structures in line with their own internal cost structures, internal strategies for mobilization of deposits, in line with their own levels of assets that they've been able to mobilize over time, and also, of course, also looking at some other dynamics such as the concentration within their own tier group. So this is the conclusions that we draw from this paper, and we're keen to invite discussions around this paper. And now that I'm here, it gives me great pleasure to invite the discussant for this paper, who is actually Mr. Jared Osoro from FSD Africa, to give